The banking system is showing cracks that most people aren't paying attention to. While everyone's focused on their daily lives, something fundamental is shifting beneath the surface of our financial system. And the smart money? They're not waiting around to see what happens next. Let me show you what's really going on right now. Central banks around the world are buying gold at a pace we haven't seen in modern history. We're talking about institutions that literally create money out of thin air, choosing to exchange that money for physical metal. Think about that for a second. The very entities that control the printing presses are trading their own currency for gold. What do they know that you don't? The numbers tell a story that should make every person with savings sit up and pay attention. Central banks have been net buyers of gold for over a decade now, but the acceleration we're seeing recently is unprecedented. These aren't small purchases either. We're talking hundreds of tons being moved into vaults across the globe. China, Russia, India, Turkey, Poland, countries that rarely agree on anything, are all doing the exact same thing. They're loading up on gold. Now, you might be thinking this is just standard reserve diversification. That's what the mainstream financial media wants you to believe. But when you dig into the details, when you look at the timing and the scale, a different picture emerges. These central banks aren't just diversifying. They're preparing. Let me take you back to a moment in history that changed everything. August 15th, 1971. President Nixon appeared on television and announced that the United States would no longer convert dollars to gold. Just like that, the last link between the dollar and anything tangible was severed. The Bretton Woods system, which had governed international finance since World War II, was dead. What happened next? Gold, which had been fixed at $35 an ounce, began to float. And it didn't just float, it soared. Within a few years, gold hit over $800 an ounce. That's not just a price increase, that's a complete revaluation of what money actually means. But here's what most people miss about that period. It wasn't just about gold going up. It was about the dollar losing its anchor to reality. For the first time in American history, the currency was backed by nothing but faith in the government. And that faith, as we've learned over the decades since, can be a fragile thing. Fast forward to today, and we're seeing echoes of that same dynamic, but on a much larger scale. The difference is that now, it's not just the United States making monetary decisions that affect the world, it's a multipolar financial system where trust is breaking down across the board. Look at what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa, and now they're expanding to include more countries. These aren't small economies. Combined, they represent billions of people and a massive chunk of global GDP. And what are they talking about? Creating alternatives to the dollar-dominated system. They're discussing trade in their own currencies. They're building payment systems that bypass Western financial infrastructure. And yes, they're backing it all with gold. This isn't conspiracy theory. This is documented policy. Russia and China have been explicit about their desire to reduce dependence on the dollar. They've watched what happened when the United States used the financial system as a weapon, freezing assets and cutting countries off from SWIFT. They've learned that lesson, and they're building alternatives. But here's where it gets really interesting for you and me. While these massive geopolitical shifts are happening, while central banks are stockpiling gold, what's the average person doing? They're keeping their wealth in banks, in dollars, in assets that are completely dependent on the stability of a system that's showing more cracks every day. Think about your own situation for a moment. If you have money in a savings account, what's it earning? Maybe 1%, 2% if you're lucky? Meanwhile, real inflation, not the government's carefully massaged numbers, but the actual cost of living increases you experience every time you go to the grocery store or fill up your gas tank, is running much higher. Your purchasing power is being eroded every single day. The banks know this. They're not stupid. They see the same data we do. They understand that the current system is built on a foundation of debt that can never be repaid. The United States alone has over $30 trillion in national debt. That number is so large it's almost meaningless. How do you even conceptualize $30 trillion? Here's one way to think about it. If you spent $1 million every single day, it would take you over 80,000 years to spend $30 trillion. That's how much debt we're talking about, and it's growing every single day. Every second, the national debt increases by tens of thousands of dollars. Now, there are only 3 ways to deal with debt of this magnitude. You can pay it back, you can default on it, or you can inflate it away. Paying it back isn't realistic. The numbers are too large and the political will doesn't exist. Defaulting would be catastrophic. destroying confidence in the dollar overnight. So what's left? Inflation. Print more money. Make each dollar worth less. And suddenly that debt becomes more manageable in nominal terms. But here's the problem with that strategy. When you inflate the currency, you're not just making the debt smaller. You're making everyone's savings smaller too. Every dollar you've worked for, every dollar you've saved, becomes worth less. It's a hidden tax that most people don't even realize they're paying. This is where gold comes into the picture. Gold doesn't care about monetary policy. It doesn't care about political decisions or government debt. Gold is simply a store of value that has maintained its purchasing power for thousands of years. An ounce of gold in ancient Rome could buy a fine toga and sandals. An ounce of gold today can buy a quality suit and shoes. The purchasing power remains remarkably consistent across millennia. But we're not just talking about gold as a long-term store of value. We're talking about gold as a response to an immediate crisis in confidence. And that crisis is accelerating. Look at what happened in the banking sector recently. We saw major banks fail. Not small regional banks, significant institutions that people trusted with their life savings. And what was the response? Government bailouts, emergency measures, assurances that everything is fine. But if everything is fine, why do they need emergency measures? The truth is that the banking system operates on a fundamental vulnerability. It's called fractional reserve banking. When you deposit money in a bank, the bank doesn't keep that money sitting in a vault. They lend it out. They might keep 10% in reserve and lend out the other 90%. This works fine as long as everyone doesn't want their money back at the same time. But what happens when confidence breaks down? What happens when people start worrying about whether their bank is safe? We've seen this movie before. It's called a bank run, and it can destroy even healthy institutions overnight. In the age of digital banking, a bank run doesn't require people lining up outside. It happens at the speed of a mouse click. Billions of dollars can flee an institution in hours. The government will tell you not to worry. They'll point to FDIC insurance. Your deposits are protected up to $250,000, they say. But think about what that really means. The FDIC has a fund of about $120 billion. The total amount of deposits in the U.S. banking system? Over $17 trillion. Do the math. If there's a systemic crisis, if multiple major banks fail simultaneously, that insurance fund is a drop in the bucket. What would actually happen in that scenario? The government would have to print massive amounts of money to cover the deposits. And we're back to inflation, back to the devaluation of the currency, back to your purchasing power being destroyed. Now, I want to pause here for a moment, because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I've put together a free guide on how gold IRAs work. It's in the description below. This covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth checking out if you're thinking about protecting your retirement savings. But let me get back to what's happening in the markets right now. The gold market itself is fascinating when you understand how it actually works. Most people think of gold as a simple commodity. You buy it, you own it, you can sell it. But the reality is much more complex. The gold market is split between physical gold and paper gold, and that distinction matters more than most people realize. Paper gold includes things like gold ETFs, gold futures contracts, gold certificates. These are financial instruments that represent claims on gold, but they're not actual physical metal. And here's the critical point. There's far more paper gold in existence than there is physical gold to back it up. Some estimates suggest the ratio is over 100 to 1. For every ounce of physical gold, there are over 100 ounces worth of paper claims. This works fine in normal times. Most people who own paper gold never actually want to take delivery of physical metal. They're just speculating on the price. But what happens in a crisis? What happens when people start demanding physical delivery? We've already seen hints of this. During periods of market stress, the premium for physical gold over paper gold has spiked dramatically. Dealers have run out of inventory. Delivery times have stretched from days to weeks or even months. This is a market that's supposed to be liquid and efficient, but when push comes to shove, the physical metal isn't there. The COMEX, the major exchange where gold futures are traded, has relatively small amounts of physical gold in its deliverable inventory compared to the total number of contracts outstanding. If even a small percentage of contract holders demanded physical delivery, the system would be in serious trouble. This is why central banks are buying physical gold, not paper gold. They understand the difference. They want metal in their vaults under their control, not promises on a piece of paper or a computer screen. Let's talk about supply and demand fundamentals, because this is where things get really interesting. Gold is unique among commodities. Almost all the gold ever mined still exists. It doesn't get consumed like oil or wheat. It gets recycled, melted down, reformed. The total above-ground stock of gold is estimated at around 200,000 tons. Annual mine production adds roughly 3,000 tons to that total each year. That's about a 1.5% increase in supply annually. Compare that to the money supply, which can be increased by central banks at whatever rate they choose. In recent years, we've seen money supply growth of 10, 20, even 30% in a single year. This is basic economics. When the supply of something increases rapidly, its value decreases. When the supply of something is constrained, its value tends to hold or increase. Gold's supply is constrained by geology and the difficulty of mining. Money's supply is constrained only by political will, which is to say, it's not really constrained at all. On the demand side, we're seeing multiple powerful forces converging. Central banks are buying, as we've discussed. But it's not just central banks. Wealthy individuals around the world are increasing their gold allocations. Institutional investors are taking notice. Even retail investors, regular people who've never owned gold before, are starting to pay attention. There's also industrial demand for gold. It's used in electronics, in medical devices, in aerospace applications. This demand is steady and growing as technology advances. And then there's jewelry demand, particularly from countries like India and China where gold has deep cultural significance. All of these demand sources are competing for a relatively fixed supply. And when demand exceeds supply, prices rise. It's not complicated, but the implications are profound. Let me tell you about what happened in 2008 because there are parallels to today that should concern everyone. The financial crisis hit. Major institutions were failing. The government was bailing out banks with taxpayer money. People were scared. They'd watched their retirement accounts get cut in half. They'd seen the value of their homes collapse. Trust in the financial system was at an all-time low. What did gold do during this period? It went from around $800 an ounce in 2008 to over $1,900 by 2011. That's more than a doubling in just 3 years. People who had positioned themselves in gold before the crisis not only preserved their wealth, they grew it substantially while everyone else was suffering losses. But here's what's different about today. In 2008, the crisis was primarily about bad mortgages and over-leveraged banks. The solution was to print money and bail out the institutions. It worked, sort of. The system stabilized, though at enormous cost. But that solution created the seeds of the next crisis. All that money printing, all those bailouts, all that debt, it didn't go away. It accumulated. The problems got bigger, not smaller. We kicked the can down the road, and now we're running out of road. Today's crisis is more fundamental. It's not just about bad loans or risky derivatives. It's about the viability of the entire fiat currency system. It's about whether people will continue to accept pieces of paper or digital entries in a computer as stores of value when those pieces of paper can be created without limit. History gives us a clear answer to that question. Every fiat currency in history has eventually failed. Not most of them, all of them. The Roman denarius, the French assignat, the German Papiermark, the Zimbabwean dollar, the Venezuelan bolivar. The list goes on and on. Fiat currencies fail because the temptation to print money is too great for governments to resist. The dollar has been the world's reserve currency for decades, which has given it unusual staying power. But that status is not guaranteed. It's not a law of nature. It's a function of trust and economic power, and both of those are eroding. When the dollar loses its reserve currency status, and it's a question of when, not if, the implications will be staggering. Trillions of dollars held overseas will come flooding back to the United States. The inflation that's been exported to the rest of the world will come home. Prices will skyrocket. The standard of living for average Americans will plummet. This isn't fear-mongering. This is what happens when reserve currencies fail. We've seen it before with the British pound, which was the world's reserve currency before the dollar. The transition was painful for Britain. They went from being the world's dominant economic power to a secondary player in a matter of decades. The difference is that the dollar's fall will be even more dramatic because the dollar is more deeply embedded in the global financial system than the pound ever was. Virtually all international trade is denominated in dollars. Central banks hold dollars as reserves. The entire architecture of global finance is built around the dollar. When that architecture starts to crumble, when countries start trading in other currencies, when central banks start dumping their dollar reserves, the feedback loop will be vicious. The dollar will weaken, which will cause more countries to abandon it, which will weaken it further. It's a self-reinforcing cycle that will be very difficult to stop once it starts. And we're already seeing the early stages of this process. China and Russia are trading in their own currencies. Saudi Arabia is discussing accepting yuan for oil sales. The European Union is trying to create systems that bypass the dollar. These are not small developments. These are fundamental shifts in the global financial order. For the average person, the question is simple. What do you do about it? You can't stop these macro trends. You can't change government policy or central bank decisions. But you can protect yourself. You can position your wealth in assets that will hold their value regardless of what happens to the dollar or the banking system. Gold is the obvious choice, but it's not the only one. Silver has similar properties and is even more undervalued relative to gold than historical norms would suggest. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently well above its long-term average. This suggests that silver has significant catch-up potential. But let's focus on gold because it's the primary monetary metal, the one that central banks hold, the one that has served as money for thousands of years. The question isn't whether you should own gold. The question is, how much and in what form? Physical gold, coins and bars that you can hold in your hand, offers the ultimate security. It's not dependent on any institution or system. It's not someone else's liability. It's just metal with intrinsic value that has been recognized across cultures and throughout history. The downside is storage and security. You need a safe place to keep it, and you need to protect it from theft. Gold held in a secure vault through a reputable dealer offers a middle ground. You own physical metal, but someone else handles the storage and security. The key is making sure you actually own allocated gold, specific bars or coins with serial numbers, not just a claim on a pool of gold. Gold in a retirement account, like a gold IRA, offers tax advantages. You can roll over existing retirement funds without triggering taxes or penalties, and the gold grows tax-deferred or tax-free depending on the account type. This is particularly attractive for people with substantial retirement savings who want to diversify out of traditional stocks and bonds. The important thing is to take action before the crisis hits. Once the banking system is in trouble, once people are panicking, it will be too late. Premiums will spike, availability will dry up, and you'll be competing with millions of other people who suddenly realized they need to protect their wealth. Think about what happened during the pandemic. When people realized there might be shortages, they rushed to buy toilet paper and hand sanitizer. Stores were cleaned out in days. Now imagine that same panic, but instead of toilet paper, it's gold. Instead of a temporary shortage, it's a permanent shift in the financial system. The smart money isn't waiting. They're positioning now, while gold is still available at reasonable prices, while the system still appears stable. They understand that by the time the crisis is obvious to everyone, it will be too late to protect yourself effectively. Let me share something that doesn't get talked about enough. The gold price you see quoted in the news, the spot price, is largely determined by trading in paper gold markets. It's not really reflecting the supply and demand for physical metal. It's reflecting speculation and manipulation in futures markets. There's substantial evidence that the gold price has been suppressed through various mechanisms. Large banks have been fined for spoofing the gold market, placing fake orders to manipulate prices. Central banks have been accused of leasing out their gold to keep prices down. The whole system is designed to make gold look less attractive than it really is. Why would they do this? Because gold is a competitor to fiat currency. When gold prices rise, it signals that people are losing faith in paper money. It's a vote of no confidence in central banks and governments. They have every incentive to keep gold prices suppressed to maintain the illusion that everything is fine. But suppression can only work for so long. Eventually, physical demand overwhelms the paper market manipulation. We saw this in the 1970s when gold broke free from the $35 peg and soared to over $800. We're seeing it again now as the gap between paper and physical markets widens. When the paper market breaks, and it will break, the revaluation of gold will be swift and dramatic. People who own physical gold will see their wealth multiply. People who own paper gold might find that their claims are worth far less than they thought, and people who own no gold at all will watch their purchasing power evaporate. This is not about getting rich quick. This is about preserving wealth through a period of monetary chaos. It's about making sure that the money you've worked your entire life to accumulate doesn't disappear in a puff of inflation or a banking crisis. Consider the perspective of someone who lived through the Weimar hyperinflation in Germany in the 1920s. People who had their savings in marks saw their wealth completely destroyed. A lifetime of savings became worthless in a matter of months, but people who had converted their marks to gold or other hard assets were able to preserve their wealth and rebuild after the crisis passed. The same pattern has played out in every hyperinflation throughout history: Venezuela, Zimbabwe, Argentina. In each case, people with hard assets survived while people with paper currency were wiped out. The specific circumstances differ, but the pattern is always the same. Now, I'm not saying we're definitely headed for hyperinflation in the United States. The dollar is still the world's reserve currency, and that provides some protection. But we're clearly headed for a period of significant monetary instability. The debt is too large, the money printing is too aggressive, and the loss of confidence is too widespread for things to continue as they have been. In this environment, gold is not a speculation. It's insurance. It's a way to make sure that no matter what happens to the banking system, no matter what happens to the dollar, you have wealth that will hold its value. You have something that can't be printed, can't be devalued by government decree, can't disappear in a banking crisis. The time to buy insurance is before you need it. Once your house is on fire, it's too late to call the insurance company. Once the banking system is in crisis, it's too late to protect your wealth. The decisions you make now, in this moment of relative calm, will determine whether you preserve your wealth or lose it in the chaos to come. Look at what the wealthy are doing. Look at what central banks are doing. Look at what the smart money is doing. They're not sitting in cash. They're not trusting the banking system. They're converting paper wealth into hard assets, with gold at the top of the list. You have the same opportunity they do. You can make the same moves they're making. The difference is that they have advisors and analysts telling them what to do. You have to figure it out yourself. But the information is available. The warning signs are clear. The question is whether you'll act on what you know. The banking system is more fragile than it appears. The dollar is more vulnerable than most people realize. The financial system is built on a foundation of debt and money printing that cannot be sustained indefinitely. These are not opinions. These are facts that anyone can verify by looking at the data. What you do with those facts is up to you. You can hope that somehow things will work out, that the government will fix the problems, that the system will muddle through. Or you can take responsibility for your own financial security and position yourself for what's coming. Gold has been money for 5,000 years. It will still be money long after today's fiat currencies have joined the long list of failed monetary experiments. The question is whether you'll have some when the current experiment ends. The banks are showing cracks. Central banks are buying gold at record pace. The smart money is positioning for a major shift in the financial system. The warning signs are everywhere for those willing to see them. What you do next could determine whether you preserve your wealth or lose it in the crisis to come. The choice is yours, but the window for action is closing. Don't wait until everyone else figures it out. By then, it will be too late.